Very good day, friends. We are going to start with a new topic which is on company accounts. Before we get into the accounting part of this, let us first understand what a company form of an organization is. A company, in simple terms, is a group of individuals, okay, or group of persons. I wouldn't say individuals, a group of persons who come together for a common objective, right? So, who do business together for a common objective. What differentiates this group of persons from a firm and a company? When we say a firm, the persons are not identified separately from the organization or from the business. Whereas when we speak about a company has a separate legal entity. So a company becomes a person on its own, which is created by the course of law. So this particular companies will have separate entity, separate identification, and they are capable of acting in their own principles, right? So the persons who are forming the company will be away from or will be treated separate from the company in terms of their legality. So that is what is the major differentiating factor between a firm or a sole proprietorship and a company. Now, so other features of a company that we would have come across is company has a common seal. It is an artificial person. It is it has a limited liability generally. What do you mean by limited liability? The company's liability to settle its debts will be unlimited, whereas the persons who are investing in the company need not extend the liability to their personal assets. Say for example, if a person has invested 10,000 in a company, and if suppose there are future cases where he has to settle debts, then apart from the money that he has invested, no further amount will be required to be paid by him, which means that his personal savings or personal assets will not be utilized for the company's debts. So that is what is the meaning of limited liability, right? So being a separate legal entity, the company operates by course of law. The company has its own set of rules and regulations which are drafted under two documents which we call as Memorandum of Association and Articles of Association. So a Memorandum of Association sets the base for the basic details of the company, like the name, place, what it is going to do. In other words, the objective, all these details. Whereas the articles of association will indicate on how the company's operations will be taking place, right? So these are all the basic things about a company. So a quick summary, salient features of company. So it is a separate legal entity, in other words, an artificial person. It has a limited liability for shareholders or for owners. It is having a common seal. There is a separation of ownership and management, and there will be multiple persons in ownership, right? So the next thing that we need to understand is what are all the types of companies. We would have heard about companies incorporated in India, outside India, or foreign companies. Then companies established for the purpose of charity, with capital, without capital. You have multiple forms, but predominantly they will come under this category is called as number one, a public limited company or a private limited company, or a category that has been introduced recently is one person company. So what is the difference between a public limited and a private limited company? A public limited company is a company where it does not have any restriction as to the number of people who are in ownership, right? Or the number of people who contribute the capital. Whereas a private limited company has a restriction on the number of people who own the company. There are also other restrictions like the owners cannot transfer their shares to other persons. There is a restricted transfer, right? So there are certain restrictions for a private limited company, but these restrictions would not be applicable for a public limited company. More about these you would be learning in detail in your law, right? So I'm not getting into the details of it. So overall, the types of companies that you would have come across is public limited company, private limited company, one person company. One person company is something that has been new to the Companies Act. In 2013 Act, this was brought in. This is more like a company formed with just one owner, like a sole proprietor, but in a company form of organization. This is just to give benefits for small business, startups, etc. Right? So these are all the types of company on the whole. So coming to the accounting aspects. Every company has to maintain books of accounts, which is mandatory under the company law. It has to maintain the books of accounts under accrual system of accounting. Okay, which means it cannot follow the cash basis accounting. It has to follow mercantile basis of accounting, right? So a company, when it has to maintain books following accounting principles, we have learned about how accounting will take place, right? From journal, ledger, trial balance, everything is going to remain the same. But when it comes to the final stage, preparation of final accounts, a company is going to prepare final accounts, which is your profit and loss account and balance sheet, in the format that is described under the Companies Act. The Act specifies certain format for uh, the company form of organization. So it is not like your T format where we have liabilities, assets on each side. It is going to be a vertical format where you will have items on a line by line basis. So the format, the way it has to be presented and disclosed is given under the Companies Act. Clear, friends? Okay. Though the format of company is different from other forms of presentation, as at foundation level, learning the format is not mandatory. Okay. This is going to be your learning at intermediate levels. So let's not go into the format as such. Okay. So now what is the thing that you will be learning which is different from other accounting principles or slightly away from other accounting principles? The major area of difference is accounting for shares, right? And accounting for long-term liabilities like debentures. Okay, these are the areas where we are going to have different principles than other forms of organizations. So let us now come to one by one. The first area is accounting for shares. So that is what is going to be our discussion in this video. The capital of the company is actually called as the share capital. So why do we call this as a share capital? The reason is we all know that company is going to have multiple ownership. So the capital is going to be split into several fragments or several parts of equal denomination or of same denomination, and each such part is called as a share, right? So you will have multiple shares in the total capital of the company. Why is this required? This is required because we are going to deal across multiple people. So it is better if we have equal levels of splitting up, right? So that is the idea behind creating this share capital. Now, in the books of the company, we will not be worried about which person is taking up that share capital. Okay, say for example, if there are say 1,000 shares of rupees 10 each, which means 1,000 into 10, 10,000 is the total capital. I am not worried about which person takes how many shares. All I am worried about is that how much rupees has come into the company as capital. Okay, so in accounting, usually what will be the method of accounting that we will do? We will be recording a capital as, say, if X is the person who has contributed capital, then in the books of accounts we will be writing as X is or cash or bank account debit to X's capital account or to Y's capital account. That is how we used to be writing. Now we are not going to be mentioning the person's name in any place in the books of accounts for owners or the capitals. Okay, why? because these names can keep changing. Every time it changes, it is not going to be practically possible to keep changing the accounting transactions. So this keeping a track of which person has contributed how much money is going to be in a separate register called as register of members or register of shareholders. It is like, in simple terms, if I have to say, it is like your attendance register, right? So it is going to be a separate list on which you will be recording all this. But in the books of accounts, we will only be recording as to how many people or how much share capital has actually come into the books of accounts. Say for example, if you have received out of 10,000 rupees, if you have received total capital worth 8,000 rupees, then we will only be writing it as bank account debit to share capital 8,000. We will not be mentioning that 8,000 which person has brought. That will not come in the journal entries, right? That is why if you see in any journal entries in company accounts, we will never be using the names of the owners. We will only be using the word share capital, right? Now when we speak of share capital, there are two types of share capital. One, equity share capital and preference share capital. What do you mean by the word equity and preference? So first, let me speak about preference. The word itself says that these shareholders are given a preference. Preference means priority treatment. Okay. In what terms are they given a preference? Any person who has invested in the company or owner will get the profits of the company. We know this rule, right? Now, that profits will be distributed to the shareholders in the form of dividends, right? In the form of dividends. Now, preference holders have a right to receive this share of profit or dividend before the other shareholders. Before the other shareholders. So they have a priority treatment. Similarly, if I am going to close the company, these preference holders will have the right to receive their capital first before the other people. Also, for preference holders, the share of profit, whether it is fluctuating or not, they will always be having a right to receive a constant share of profit, say 10 percentage, 15 percentage of capital, right? So they will have always a constant share of profit will be paid to them. Okay, so this is regarding your preference capital. So generally what will happen is they will be people who are shareholders but treated on a priority basis. Whereas all other shareholders come into this basket called as equity shareholders or equity share capital. They are the actual owners of the company. They will be the people who are involved in decision making of the company, right? So while preference holders are given priority settlement, they may or may not be involved in decision making for the company, okay? Whereas equity shareholders are the major decision holders, right? So this is regarding the types of share capital. Now, this chapter we are going to be learning about how to account for equity share capital, right? We are not moving to preference share capital. We will be learning on accounting treatment for equity share capital. Before we move on to the accounting entries, let us understand the various stages of this equity share capital. So let us understand the process so that it is easy for you to understand the flow of accounting. Now, whenever we speak of equity capital, okay, when it has to be issued to the people, what happens first? First, the company being an artificial person should actually declare that this will be the maximum amount of capital that I will be raising, because it is an artificial person. People should not take it for granted and we should not be issuing capital as and when we need, right? So there is a maximum limit that has to be declared. Where it will be declared, the company will mention it in the memorandum of association that this will be the maximum authorized capital or maximum capital that the company will issue. That is called as the authorized capital of the company. Next, once the company has authorized this capital, okay, Next, now comes the actual process. It has to start the steps for issuing the capital. Now, if it is a private limited company, it will know the people who are going to buy this shares generally or take this capital. But a public limited company, it has to follow this procedure called as issuing of prospectus. Okay, so what I'm going to do here is that I'm going to call up for the public and invite them for applying for the shares of the company. That is called as issued capital. The amount that the company floats to the common public, says that please subscribe to my shares. That particular amount is called as issued capital. How will it generally go to this issue? There is something called as a prospectus. A prospectus is in simple terms like an advertisement. Okay, indicating what are all the details of the company and saying that we are inviting offer for this particular applications of shares. In contract act, we would have learnt there is something called as offer acceptance. But before offer comes invitation to offer. Prospectus is an invitation to offer, because the company is not saying that you take up shares. The company is inviting whoever wants can come and apply to take up these shares, right? So that capital is called as issued capital, right? So issue of prospectus or process for application of shares. Next, what happens? Seeing the prospectus or after hearing about this, people will apply. That process is application for the shares. Next, after shares are being applied for, okay, the company will see how much applications it has received. Now this application is called as offer, right? This application is offer. But when will the actual contract get completed? The contract is going to get completed only on acceptance, which who has to do? The company has to do. The company has to now see the applications and allot these shares. Allotment means the company will give a certificate to these particular people saying that, okay, these many shares are registered in your name, right? These many shares are for your name. So that step is called as allotment of shares. Allotment of shares. That allotment stage is where we speak about subscribed capital. Okay, what is this subscribed capital? Where how much I have issued and how many shares I have actually allotted or I have received for allotment, right? Received for allotment and allotted will happen simultaneously. Okay, we will come to this details separately also. The next step. What is the next step after allotment? Okay, when you actually allot the shares, you will be asking them to pay the capital. In fact, when they apply itself, the person has to pay some amount of the capital. Say if he's going to take up shares which are of 10 rupees each, then maybe you can say at the time of application itself, you have to pay 2 rupees to the company's bank account, right? Now, when shares are allotted, you can ask them to pay some more amount, pay another 3 rupees or pay the full balance amount. Okay, you can ask them to pay some amount or further full amount, right? So the amount that the company asks, okay, or the amount that the company actually raises by asking is called as called up capital, because the company calls for means asking for, calls for this capital contribution. So that is called as called up capital, right? So what differentiates is subscribed and called up? Subscribed capital will be at your face value or will be at the full amount of the shares. But I may not have called for the entire amount of the shares. Say for example, I would have said that, okay, 10 rupees per share. Now I don't need all the 10 rupees. Let us say I will call only 8 rupees. 8 rupees into how many ever shares I have. Say if I have 1 lakh shares, 8 into 1 lakh, 8 lakhs I am going to call. Okay. So once you ask for this 8 lakh rupees, people will start, whoever has subscribed is going to now pay the amount. That is called up. Now what will happen to the 2 lakhs? That 2 lakhs is subscribed. Who has to pay? By the people who have subscribed only. But should they pay now? No, because the company has not asked for this amount. So that is called as uncalled capital. So that is called as uncalled. Now this uncalled capital can be reserved by the company whenever it wants, it can call, or it can even reserve it till the end of its period, which is called as reserve capital. So it will say that I am not going to call this amount anytime now. I will use it only when I need it for winding up or closing my business. That is called as reserve capital. A portion of uncalled capital reserved for the future. Right? And the last step is, once it is called, that amount that the shareholders are going to pay. Okay. So if you've called up for 8 lakh rupees, people will start paying up one by one. Right? Sometimes it may happen that one person may not pay, two people may forget to pay, all that will happen. So suppose you are receiving only 7,95,000 rupees. Then that 7,95,000 is the actual money that you have received in hand. You had authorized capital, issued capital, subscribed capital. That all will not decide what is the amount that you have received in hand. What is the actual amount that you have received in hand will only be the amount that is in your bank account. That is called as paid up capital. And that is where your balance sheet amount will appear. Right? So capital that is shown in the balance sheet will be the amount of paid up capital. In simple terms, whatever amount that you have received in the bank account. Right? So that is called as paid up capital. Clear, friends? So this is the stages of issue of equity share capital. Generally, this stage will be common even for preference share capital. The stages will not be, there will be a slight difference, but the stages predominantly will not differ. Clear so far, friends? Now let us start the accounting aspects with this illustration. A company has authorized capital of 10 lakhs, which is 1 lakh equity shares of rupees 10 each. It decided to issue 75,000 shares. Now, it is not just sufficient if you say how many shares you are going to issue. The amount at which you are going to issue will also matter, which is called as the issue price. This issue price can generally be at the value that is the denomination. What is the denomination here? Rupees 10 each. In other words, if you are going to get a certificate, that certificate will have a denomination. That denomination is this 10 rupees. That is called as par value or face value. Par value or face value. Okay, so if I'm going to issue 75,000 shares at rupees 10 itself, then how much money I'm going to collect from the people? 75,000 shares into 10 rupees or 7,50,000 rupees is what I'm going to expecting to collect. So that is called as issue at face value or par value. This is one type of issue. Second type of issue can be issue at premium. What do you mean by issue at premium? Issue at premium means issuing above the face value. Issuing above the face value. Say if I'm going to issue 5 rupees above the face value. So I'm actually going to collect 10 rupees plus 5 rupees above that, which means I'm going to totally collect how much? 15 rupees. 15 rupees. Right? The third scenario is issue at discount, which is below the face value. I am going to collect it at a price which is less than 10 rupees. Right? Now, Companies Act 2013 has banned this or prohibited this issue at discount. Has banned this issue at discount, except for certain specific cases. We will come to that cases later, right? So as per the law, what are all the agreed modes of issue? The agreed modes of issue are at face value or at premium, which is above the face value. So what will happen is, this premium amount will also be collected from the shareholders at whichever stage that the company wants to decide. Am I clear, friends? So now in this illustration, what is the authorized capital? 10 lakhs. What is the issued capital? 75,000 shares into 10 rupees or 7,50,000. Whenever we speak about the capital, it has to be always quoted at face value only. So capital will always be shown at face value or par value only. So even if you are going to issue 75,000 shares at a premium of 5 rupees, so your actual collection is going to be 75,000 into 15 rupees. But when we say what is the issued capital, or whenever we use the word capital, capital is not 75,000 into 15, capital is only 75,000 into 10. So capital will always be represented at face value only. This is a main thing that you have to remember, because the denomination for the share is only the face value. So capital should be represented only at that denomination, because the word itself is, it is share capital. So the denomination will remain constant. It will never change. Right? Clear with this? So now let's move on to one by one. First stage. Okay. So authorized capital is already there. Next, what happens? The company invites for the shares. Once company has invited using the prospectus, in the prospectus itself, it will mention at what price it is going to issue, whether it is at 10 rupees or 15 rupees, whatever is the case. Now, the first stage comes where when people are going to apply for the shares. Now, when they are going to apply, the company will specify that in the prospectus itself that a portion of this share capital has to be paid at the time of application. Say 2 rupees per share has to be paid at the time of application. So people will apply, okay, in the document that is mentioned, and along with that they will also pay the 2 rupees. Say if I am a person who is applying in X company, then what I will do, if I suppose want to take up 100 shares, I will pay 100 into 2, 200 rupees I will have to pay to that company X. So company receives the money at the time of application. So the first stage is receipt of application money. Receipt of application money. So what is the entry for receiving this, friends? We all know bank account debit. Bank account debit. 2. Okay, we are not going to use the word capital here. The reason is that we all know here that application is only the offer. The allotment is the actual stage where agreement is complete, acceptance is going to happen. So till that we are not going to use this share capital terminology. So this will be parked in a temporary account called as share application. Okay, so bank account debit to share application. Clear? So this is when the application money is received. So what will be the amount? The amount will be total number of shares for which application is received into application money per unit or per share. Clear, friends? So this is at the time of receipt of application money. The next stage will be allotment, right? Which is the acceptance stage. So once applications are received, the company scrutinizes the applications and processes this application. So again in the prospectus, the company would have said, once we accept your application, in other words, once the shares are allotted, you will have to pay further money at the time of allotment, which can be another 3 rupees or 4 rupees, or it can be the entire balance amount, whichever the company decides, right? So the company would have mentioned the same in the prospectus. Please remember, at the prospectus itself, it would have mentioned clearly at which level what money has to be paid, right? So now the company is going to allot the shares. Okay, so allotment. Now here, this is where the actual conversion of share capital is going to happen. right? So when we speak of share capital, what is the amount that is going to get converted to share capital, friends? The amount that you have received so far. For example, if you have, at the time of application, you have received 2 rupees per share. At the time of allotment, suppose you are going to receive 3 rupees per share. Okay, so what is the total amount that you are actually going to receive till now? 5 rupees. But what is the share capital value? 10 rupees. So the question is that, should I record share capital credit 10 rupees per share or 5 rupees per share? The answer is very clear. If you record 5 rupees only, you will have a corresponding debit, because your bank account will be debited only by 5 rupees per share. I will be receiving only that much amount. So we are not going to record the amount that we have not yet called for. Okay, only the amount that is called up is going to be recorded. So the clear thing that you have to remember here is, called up value alone will be recorded as capital. Clear? It is different whether persons have paid or not, whether the company has called or not. Only when you call, the other person is going to pay, right? So only at the time of calling, the recording of transaction has to happen. So now comes this allotment. Before the allotment, let us first understand there are two types of issue. One, issue at face value, or issue at premium. So if the issue it is at face value, if the issue is at face value, then what will be the journal entry? The journal entry is going to be, okay, share application account debit. Why? Because you have already received some amount in the form of share application, which is sitting in this temporary account. Now I am converting that temporary account to share capital, right? So I am cancelling this account. So share application account debit. Next, share allotment account debit. Why this entry? The next stretch you are going to receive the amount in the form of allotment. So I am creating a temporary account for receiving funds in the form of allotment money, right? To equity share capital. To equity share capital, right? If the issue is at premium, if the issue is at premium, this part of the entry is going to remain the same. Share application account debit, share allotment account debit will remain the same, right? Now, generally what will happen is, if you are asking this 10 rupee share at 15 rupees, that extra 5 rupees will generally be collected at the time of allotment itself. Mostly, okay, this is how it happens. It is collected at the time of allotment itself. So, what happens? You are going to receive this extra money at the time of allotment. Now, like I told you, equity share capital has to be represented only to the extent of face value of the shares. That 5 rupees extra that you are going to collect at the time of allotment is not equity capital. It is apart from capital, or it is in addition to capital. So that amount has to be recorded in a separate account called as securities premium. Securities premium. Right, friends? So whenever it is an issue with a premium, then it is share application account debit, share allotment account debit, to equity share capital, to securities premium. This securities premium will represent any amount that you have collected in excess of the face value of the shares, right? This premium account has very restricted usage. The usage for this premium will be specified under the Companies Act. There are only certain cases where I can use this money. I cannot use this money for all common purposes, right? So that is the securities premium. Now, next entry. So you have actually allotted. Now what I should do? I received application money. I allotted the shares. Now I should receive what money? I should receive allotment money. So as and when allotment money comes into picture, what I'm going to do? I'm going to record the receipt entry. So what is the entry for receiving the allotment money? Same. Bank account debit to share allotment. Bank account debit to share allotment. So if you see this application, share application account, share allotment account will all be temporary accounts. It will be first credited, then debited, debited, credited. Alternatively, it will happen. So you can ask why we are doing this. We can directly write it as bank to equity share capital. No. The reason is that generally there will be a timing gap. Your allotment date and the amount received date will not be on the same dates. So it is always better for transparency purposes. We will have to keep it as a separate account. Right? So this is bank account debit to share allotment account. This is at the time of receiving the allotment money. Now, if you are receiving the premium amount, that premium amount will also be under the share allotment. So automatically it will get included in this entry. So receiving allotment money. Clear so far, friends? The third step. Okay. So we have received the allotment money also. Now from this position on, they have all been allotted the shares and they are now the shareholders of the company. Now you may have the balance amount in the share capital that is yet to be called, the uncalled capital, right? So that uncalled capital, if you decide to call, okay, that is called as call money. Okay. Generally, a company can make up to 3 calls. Maximum of 3 calls. But mostly what happens is people generally collect the full amount at the time of application allotment itself in today's world, because we all have this demat transactions and all that. But earlier days when they used to collect it in parts, then they used to collect it in different stages. So after allotment, they can go up to 3 stages, which is call 1, call 2, call 3. Right? First call, second call, or third and final call. So at each stage, they can split and get the capital. But how many ever they are going to make has to be already given in the prospectus. Everything will be clearly mentioned in the prospectus. Right? Now, when call money has to be received, the same flow of entries is going to happen. One, when you are actually receiving the call money, now remember in your balance sheet, till the allotment stage, when you have recorded the equity share capital, it is only having the amount of called up value till that allotment. Say if it is 5 rupees, 5 rupees. Now when you are calling the next money call only, the amount of share capital is going to increase. So share capital entry also will be passed. What is the entry to be passed? Share call account debit. Share call account debit to equity share capital. So by this, what will happen? Your equity share capital will also increase by the amount that is going to be called up. So every time your equity capital will represent only the called up value, right? The called up value. I'll come to the paid up value later. And at the time of receiving the money, the entry is going to be very simple. Bank account debit to share call. Bank account debit to share call. Clear so far, friends? So this is at the time of calling. So with that stage, your entire share capital can be called up. But you remember when we were speaking about shares, I told you that in the balance sheet, the paid up value will appear. The reason is that sometimes some persons who have to whom we have called the money, they may have forgotten or they may fail to pay the money that has been called up. So what will happen? I would have passed the entry, share call account debit to equity share capital, or share allotment account debit to equity share capital. I would have passed. But when the bank entry will be passed? Only when they are actually paying. Sometimes what will happen? They may fail to pay, which means your equity share capital has raised, but actually speaking, you have not received the money from that person. So when you have not received the money from that person becomes like a debtor to the company. He becomes a debtor to the company. So that transaction where the persons who have not paid these call money or allotment money, those kind of amounts are called as calls in arrears. Calls in arrears. So amount which has been called but not paid. But not paid. Can call arrear happen at the time of application? No, because if you are not paying the application money itself, then your application itself is not going to be processed. So, calls in arrears can happen at two places, either at the time of allotment or at the time of calls, right? So, in any of these two places, people may end up not paying the money that has been called for. Now, what will be the journal entry? Right. So what is the journal entry here? What was the entry when we passed for receiving the money? Bank account debit to share allotment or to share call, whichever is the case. Here we are going to treat them as a debtor. So we are going to create an account called as calls in arrears account. So the entry is going to be calls in arrears account debit to share allotment or share call, whichever is the amount which is due. So if the calls in arrears happens at the time of allotment, then it will be to share allotment. If it is happening at the time of calls, then it will be to share call. Clear, friends? So now comes this aspect of paid up share capital. What is paid up share capital? Paid up capital is nothing but called up capital minus calls in arrears. Paid up capital is called up capital minus calls in arrears. So this paid up capital will only appear in the final value as in the balance sheet. Okay. So for example, at the time of application 2 rupees I have called. Allotment 3 rupees. Call 2 rupees. So how much totally I have called? Out of a 10 rupees face value, I have called for 2 plus 3 plus 2, which is 7 rupees. So what is the called up capital? Number of shares, say 75,000 shares into 7 rupees. Now in that, suppose one person has not yet paid calls to some extent of say 5,000 rupees, he has not paid up the calls. So what will happen? Your called up value is 75,000 shares into 7 rupees. But to the extent of 5,000, I don't have any money received in the bank account. So I will say minus calls in arrears 5,000. The net amount will be the actual amount that will be shown in the balance sheet. That amount will only correspond to the capital value in the balance sheet. This breakup will be shown as a separate note in the balance sheet itself. After the balance sheet is over, you will show a separate note for this breakup. That breakup will say what was the authorized capital, issued capital, then how much I called up, less calls in arrears, total paid up. This final paid up will be in your main balance sheet value. Clear, friends? So this is calls in arrears. Now, calls in arrears are like debt. Okay, the company has to receive money from some persons, right? This calls in arrears, because it is debt in nature, this can be charged interest. If permitted by the company's regulations, I can charge interest on this calls in arrears. So interest on calls in arrears can be charged. What will be the interest? At maximum of 10% per annum. Maximum of 10% per annum. So if the person is going to pay this calls, if at all he is going to come and pay this call money, then I can, if the law permits or if my bylaws permit, then I can charge interest and collect this amount along with interest. So for the company, this interest becomes an income. So what will be the entry? Bank account debit to interest on calls in arrears, right? This interest on calls in arrears is a nominal account which is an income. So it will be taken to what? It will be taken to profit and loss account. Clear, friends? Okay, so this is about calls in arrears. What happens when the calls in arrears are paid? When the calls in arrears are paid, it is like a debtor payment entry. So bank account debit to calls in arrears. Bank account debit to calls in arrears. The next thing that we are going to learn is an opposite scenario to calls in arrears, which is where we have not, the company has not called for the capital, but the shareholders have already paid the amount in advance. That is called as calls in advance, right? Where capital is not called but paid in advance. So when this will happen? Suppose at the time of allotment, till the time of allotment, if I have called only for 5 rupees per share, whereas a shareholder or some of shareholders want to pay the full amount, they may pay the entire amount in advance also. So now in that case, how it will be treated is that, like if we are going to get this money in advance, yes, it is going to appear in our bank account, but will it get added to the share capital? The answer is no. Only the amount that is called up will be eligible to be taken to share capital. Minus calls in arrears, that is different. So only when it is called up, it can go to share capital. So till then, it has to be parked in an account called as calls in advance. So if calls in arrears is treated like a debtor, then this becomes like a creditor, the opposite scenario. So the journal entry when you receive calls in advance is that bank account debit to calls in advance, right? Now, like we have interest on calls in arrears, the company can also pay interest on calls in advance because the money has been received in advance. The company can also be authorized to pay interest on calls in advance. So maximum interest on calls in advance is 12% per annum. 12% per annum. So what will be the entry for payment of interest? Interest is a nominal account. So payment, or in other words, an expense. Interest on calls in advance account debit to bank. This will be the entry for payment of calls interest on calls in advance. So this will become again a nominal account, but this is a expense in nature which will be debited to your profit and loss account. Now, subsequently, when the company actually calls for that amount, these set of shareholders alone need not pay the amount at the time of calling because they have already paid the amount in advance. So what the company will do is, for this amount that is appearing in calls in advance, it will convert it to share capital at the time of calling the amount. So at the time of call, the amount will be converted to share capital. So the entry will be calls in advance account debit to equity share capital. To equity share capital. Or the company sometimes can decide, okay, this amount is lying with me for a long time. I don't want to retain this amount. Probably because I am not going to call this money anywhere in the near future. In that case, the company can also decide to refund the advance. So what is the entry for refund? Paying back the advance. So the entry will be calls in advance account debit to bank. So in that case, it will pass entry both for payment of this calls in advance refund as well as interest if it has to pay the interest, right? So this is regarding calls in advance. Now the question is that when there is a calls in advance, where will it appear in the balance sheet? we discussed that calls in arrears will be subtracted in the capital itself, so that only the paid up capital will appear in the balance sheet. But calls in advance is not a capital at all. So it cannot appear in the balance sheet in the capital column. It will appear as other liabilities. Right? It will appear as other liabilities. Because it is like a creditor, it will appear as a liability. Please remember that the shareholders, just because they have paid this amount in advance, they will not get preferential treatment for share capital with this advance amount. Right? Just because I have paid advance money does not mean these shareholders will be treated separately. They will not be treated separately. In other words, they will not have any additional power for the amount of advance paid. This amount of advance will not be treated as a capital at all. It will only be treated as some advance given by a person, right? A normal creditor. Clear, friends? So this is about calls in advance. The next aspect that we are going to be seeing here is a scenario where the number of shares that is going to be subscribed is different. So let us understand this using an example. Now, suppose if the shares that have been issued is 75,000 shares. So if it is 75,000 shares, then what does it mean? 75,000 shares have been offered. Now, when it comes to acceptance, or sorry, 75,000 shares have been invited for offer. Now, when it comes to the amount of applications that you receive, sometimes we may receive lesser applications. In other words, we may receive application only for 70,000 or 71,000 or 60,000, 65,000, something like that, number of shares. Or we can even receive applications which are exceeding the number, say 80,000, 90,000, 1 lakh you can receive. So how to deal with in both those situations is what is the topic for discussion. In case of under subscription, which is number of shares applied for is less than number issued, right? So there is one condition in Companies Act saying that whenever the company issues shares, it should receive at least 90% of its subscriptions. It should achieve at least 90% of its subscription. That is called as the rule of minimum subscription, okay, which is 90% of issued shares. Which means if the company has suppose issued 1 lakh shares, it should receive a minimum application for 90,000 shares. If it is receiving 85,000, 86,000, 89,000, even then it is not satisfying the criteria. So if minimum subscription criteria is not satisfied, then what will happen? The company cannot proceed to allot the shares. So at that step itself, the work will stop. The company cannot proceed to allot the shares, which means the company has to refund the entire application money it has received. So if minimum subscription is not satisfied, allotment cannot be made for any of the shares issued. Application money has to be refunded. Okay, if minimum subscription is satisfied, then what is the scenario here? Okay, I can continue to allot. For example, if I have asked for 1 lakh shares or issued 1 lakh shares, whereas subscription has been received for 95,000 shares. Okay, has it satisfied the 90% criteria? Yes, it has satisfied 90% criteria. Now, for the balance that has not received, we cannot do anything. The company cannot do anything about it. The company can proceed to allot the shares for this 95,000 shares. which means it has to allot for the whatever amount of subscriptions it has received. So if minimum subscription is satisfied, allotment can be made for the shares subscribed, which is actual subscriptions, right? Okay, so here my share capital will not be for 1 lakh shares, it will only be for 95,000 shares. The journal entries will all remain the same, okay, but the amount of shares alone will be as per the actual subscription. However, if it is not satisfied, then the company has to refund the application money. So what do you mean by refunding the application money? It will be returned back to the shareholders. The entry will be share application account debit to bank, right? So this is regarding under subscription. Next, coming to over subscription. In case of over subscription, which is number of shares applied for is more than number issued, is more than number issued. Now, what does this indicate? If suppose I have issued for 1 lakh shares, then if it is more, say for example, if I have received 1,10,000 applications, what do? I cannot allot all the shares applications that I have received. I can allot only to the maximum number of shares issued. So if it is 1 lakh, I can go only up to 1 lakh. If it is 75,000 issued, I can go only up to 75,000 issued. Even if you have authorized capital, you cannot exceed the issued capital, right? So subscriptions, or in other words allotment, cannot exceed issued capital. Okay, so what is the solution? If allotment cannot exceed, then to these extra applications I have to do some work. There can be two ways. One, I can choose to reject some applications and refund the application money. So ways of treatment, accounting treatment or treatment here is: first, refund of application money. Or, so refund of application money is like I will reject certain applications and say that, okay, please take your application money back, right? Or I can take up all the applications and do pro rata allotment, okay? Pro rata allotment and adjustment of application money against allotment, right? So how is this going to work? Let's understand the scenario 1 first. Now, when certain applications are rejected, it is a direct case. To those rejected people alone, we are going to pay back the application money. So for refund of application, the entry is going to be share application account debit to bank. So I am just going to refund this application money directly, right? So the balance I can continue with allotment. Now what if it is second case, which is pro rata allotment? What do you mean by the word pro rata? Pro rata means allotting or in proportion. The word itself says in proportion. So pro rata allotment means allotment in proportion. What does this infer? So for example, this 1 lakh shares which have been issued and subscribed, say it is 1,10,000. So let us take this example. 1 lakh shares issued, 1 lakh 10,000, okay, or maybe let's take a higher number, 1 lakh 20,000 shares subscribed. right? So I can probably come to a conclusion saying that if I allot this entire shares applications as it is, then I will come to how many shares? 1,25,000 shares or 1,20,000 shares, which is not going to be possible. I have to allot only 1 lakh shares. So I am going to arrive at a ratio. What is the ratio? The ratio is going to be, okay, 1 is issued is to what is the allotment? 1.2. So I can write this as a ratio of 1 is to 1.2, or I can write it as 10 is to 12, or I can write it as 5 is to 6. 5 is to 6, which means for every 5 shares that I have asked, how many shares I have received the applications for? 6 shares I have received applications for. So now what I can do, if I have to satisfy all the people who have applied, I will say that, okay, if you have asked me 6 shares, I will give you 5 shares. If you have asked me 10, I will give you 8 or 7 proportion, right? So the proportion in which I am going to allot is going to be common for all the shareholders. The proportion will be what? In the ratio of 5 is to 6, right? So let us assume if a person has applied for 15,000 shares, okay, then how much will be allotted? So how do we understand this? If a person has applied for 15,000 shares, okay, so now let us understand the ratio is 5 is to 6. So for every 1.2 shares subscribed or applied for, 1 share is going to be allotted, or in other words, for every 6 shares subscribed for, 5 shares will be allotted, right? So what is the ratio in which that we are going to do? 6 and 5. Okay, so if I have applied for 6 shares, I will be allotted 5 shares. Now I have applied for 15,000 shares. So what will be the allotment? Question mark. It is a cross multiplication rule. So how will we write this cross multiplication? Equal to 15,000 into 5 divided by 6, giving you an answer of 12,500 shares will be allotted. So any person who has applied for 15,000 shares will be allotted 12,000 shares. If he has applied for 10,000, you can apply the same proportion and find out how much he should be allotted. Clear, friends? Okay. So now this is called as pro rata allotment. Now you can ask, what has this to do with accounting? Now, accounting is not about pro rata allotment, because till the time the application is received, we are not going to enter it as share capital. And the second point, we are not going to be recording accounts as the person who has paid money, or in the names of the persons who have paid money. For us, we only have recognition as share application, share allotment. So we are not going on individual basis. But this exercise will be done separately, person by person, or to individual by individual, on a separate transaction, separate calculation. After which they will identify as to each person how many shares have to be allotted. Whoever has applied, how many shares have to be allotted. So this particular pro rata allotment will happen outside the books. Now coming to the next part. Once pro rata allotment has been made, okay, now what happens? Say for example, let us assume this person itself who has applied for 15,000 shares is going to be allotted 12,500 shares. Let us take, if application money is rupees 2 per share and allotment is rupees 5 per share. Now, when the person pays application money, he would have assumed that I will receive 15,000 shares. So he would have paid application money for 15,000 shares, right? So what will be the entry that you would have passed? Bank account debit to share application 15,000 into 2, which is 30,000 rupees. You would have passed the entry, correct? So the entry that would have been passed is bank account debit to share application, uh, 30,000 rupees. So let me pass the entry. This is your journal entry, right? Now what happens when the person is going to be allotted the shares? He will not be given 15,000 shares. He will be given only 12,500 shares, which means for the balance 2,500 shares, he has paid excess money. He has paid excess application money. Now, two options. One, the person can be refunded the excess application money. But why should I refund unnecessary process? I will say that I will keep the money. The company says that the company retains the money, and at the time of collecting the allotment money, it will adjust the amount that has already been received. So this excess amount that has been received will get adjusted. So what is the excess amount received? Excess amount received is nothing but, what is the number of shares in excess? 15,000 was asked for, 12,500 allotted. So 2,500 extra into 2 rupees, which gives you 5,000 rupees excess amount received. Now this 5,000 amount rupees will be adjusted against share allotment money. So what I'm going to say is the company will transfer this application money to allotment money. So the entry is, okay, share application account debit 5,000 to share allotment 5,000. Share application to share allotment 5,000. So this will be the journal entry for pro rata allotment. Whoever has paid excess application money, the total amount of excess application money will be calculated and it will be adjusted against share allotment, right? So now when you collect the allotment money, how much should I collect? So allotment money to be collected. What is the allotment money that I have to collect? 12,500 into how much rupees? I need to collect 5 rupees, which is 12,500 into 5 will give you 62,500 rupees minus I have already paid 5,000. So I need to pay only 57,500 now, right? So I will only be paying 57,500. So when you collect the money, your entry will be bank account debit to share allotment 57,500. So what is the total share allotment? 57,500 from bank and 5,000 from share application, total 62,500, which will match, right? So at the time of pro rata allotment, only one entry will be passed extra. What is that entry? Conversion of excess share application to share allotment. Clear, friends? Converting the excess share application to share allotment. Right? Now, what will be the share capital entry? Okay. Share capital entry will be only for issued or allotted capital. In this case, it will not be for 1,20,000 shares, it will only be for 1 lakh shares. Clear? So, will only be for allotted capital and not for the actual amount of applications received. Clear, friends? So, this is about pro rata allotment. So, when there is an oversubscription, there are two ways in which a company can treat. Either it can refund the excess application money or it can do a pro rata allotment. So, in case of pro rata allotment, you will have to calculate what is the excess application received. To that extent, the application money will be transferred to allotment account, share allotment account. All the other entries will continue to remain the Same. After that, your entries will continue. Share allotment to share capital, then bank to share allotment. All those entries will continue. Right? Clear, friends? So I have also written the entry for collection 57,500. Let me also write the journal entry for allotment. So your entry will be share application account debit, share allotment account debit to share capital. Right? So this will be for how many shares? Here I am not going to do for a single person. I will do this entry for the entire 1 lakh shares. Okay, though I pass the entry only for one person above, this will be done for the entire shares. So here it will be 1 lakh into 2 rupees. Here it is going to be 1 lakh into 5 rupees. And here it will be 1 lakh into 7 rupees. Though face value is 10, I have only called up for 7 rupees. So only 7 rupees will be considered at share capital. So what will happen is automatically share application excess money will get closed by conversion to share allotment, and share allotment will get closed by transferring to share capital account. Clear, friends? So this is about oversubscription and undersubscription. So with this, we are completing on issue of shares, equity shares. Clear so far, friends? Like mentioned above, shares can be issued by collecting cash or can be issued for any other consideration. So, shares issued for cash. Okay, your entries will be as above. Right? Whereas, if shares are issued for consideration other than cash. Say for example, we are if you are taking over some company or some company's assets, and if you are compensating the persons by allotment of shares, then your entry is going to be, right, we are not going to follow so many procedure because it is a direct allotment. Okay, so your journal entry is going to be asset account debit, whichever asset you are buying on account of issue of share capital. So whatever is the consideration to share capital, and if at all it is at premium, to securities premium, right, to securities premium. Clear, friends? Okay, so for example, if you are going to allot 5,000 shares, okay, for an asset worth, let us assume, say 6 lakhs, okay, or 50,000 shares for an asset worth 6 lakhs. Let's not go to huge numbers. We'll take some rational numbers. So, asset value 6 lakhs. Shares allotted 5,000. Sorry, 50,000. So, what will be the price? Allotment price is equal to 6 lakhs divided by 50,000, which will give you, which is 12 rupees per share, right? 12 rupees per share, or in other words, okay, 10 rupees face value plus 2 rupees premium. So what will be the journal entry? Asset account debit 6 lakhs. To share capital 50,000 into 10, 5 lakhs. To securities premium 50,000 into 2, 1 lakh. So you will get your journal entry. So this is when shares are issued for consideration other than cash. In the balance sheet, this will also appear as a part of share capital. Whereas when we write the notes to the balance sheet, we will have to write in detail saying that this many shares were allotted for consideration other than cash, meaning that we did not receive cash for these many number of shares. Clear, friends? So this is about issue of equity shares. The next topic that we are going to be seeing is forfeiture and reissue of shares. Friends, what is the meaning of forfeiture? Forfeiture means to forego the rights. Okay, to forego the rights, or in other words, to give away the rights. Right? So, what do you mean by giving away the rights? In this case, a shareholder gives away his rights as a shareholder and also gives away his right to receive his money back. Right? So the shareholder gives away his rights. So when does a shareholder have to give away his rights? Number one, when the shareholder has not paid the call money. Right? For example, if a person has to pay some call amount and he has not been paying that amount for a long time, the company can decide that this particular shareholder will no longer remain a shareholder in the company. Right? That stage is called as forfeiture of shares. So what happens in case of forfeiture? When call amount is not paid by the person, the company can forfeit his shares, which means it will take away the rights of that shareholder. Also, by forfeiting, what will happen is the shareholder will lose the right to receive the money that he has paid back. So, for example, if the shareholder originally has paid 3 rupees per share, okay, so a shareholder having 5,000 shares paid 3 rupees per share already. Okay. Let us assume called up value of share is 8 rupees. Okay. So which means the shareholder has paid only 3 rupees out of rupees 8 per share. So what is pending? 5 rupees per share is pending. So now when the company forfeits the shares, the shareholder has to ideally receive back the 3 rupees that he has paid. But no, the shareholder forfeits the right of receiving. The shareholder has to give away his right of receiving the money. The company has to retain the advance or the amount that has been received. Clear? So in this case, when shares are forfeited, the shareholder cannot receive the amount already paid to the company. In other words, the company will forfeit the amount already paid. Right? So now let's understand how the journal entries will be passed. These 5,000 shares should now be cancelled as shares, which means they will no longer form part of share capital. So share capital has to be debited. Right? Share capital account debit, right? 2. Okay. Now let us understand what will happen. Share capital account debit. What will be the amount that has been debited? How much has been the called up value that was credited? 8 rupees. So it will be 8 into 5000. 2. In that 8 rupees, I am yet to receive how much? 5 rupees. Ideally speaking, any amount that is called but not paid will be appearing as a part of calls in arrears, right? So I will be treating this in calls in arrears. So no longer it will remain in calls in arrears, it will be cancelled and brought back. What is the amount? 5 rupees unpaid. So 5 into 5000. Now comes the question. He has already paid 3 rupees. We are not going to refund it to him. So what will happen? This is like a gain to the company. The company is taking this 3 rupees from the shareholder or from this person and not going to refund this person. So it is like a gain. Okay. This is treated to an account called as share forfeiture account or forfeited shares account. Share forfeiture account or forfeited shares account. What will be the amount? 3 into 5000. So how can we take this explanation as? Okay, the amount of share capital debit will be called up value. The amount of calls in arrears will be actual calls in arrears or unpaid amount. Right? And what will be the share forfeiture? The amount which has been already paid. Amount already paid will be the share forfeiture amount. Clear so far, friends? Okay, so this is the entry when the shares are forfeited. Okay, next. If suppose this share was originally issued at a premium, okay, under that scenario 1, okay, suppose if the share was issued, same, let us assume 5000 shares, if the premium amount was rupees 4 per share, right? So what is the amount of shares issued? 14 rupees was the value of shares issued. Okay. Now if the premium amount of rupees 4 was collected along with allotment or already paid, which means the premium amount has been already paid by the person. So let us take the same example. The person having 5,000, I'm going to the previous example itself. A shareholder having 5000 shares, paid rupees 3 per share already and also paid what amount? Premium. Called up value is rupees 8. Let it remain the same. Alright. So now what would have been the journal entry that you would have passed when you would have received the money? Share capital would be credited by 8 rupees. Securities premium will be credited by 4 rupees. Correct? Share capital will only be for called up value 8 rupees. Securities premium will be for 4 rupees. The most important point is when the shares are forfeited, securities premium will not be reversed if paid. Securities premium will not be reversed if paid. So what does this indicate? Once a person has paid securities premium will remain as it is. It is not going to change its position. right? So what will be the journal entry? Share capital account debit. How much rupees? It will not be 10 rupees. It is only the same 8 rupees. So 8 into 5,000. Next, 2 calls in arrears, 5 into 5,000. 2 share forfeiture. What will be the amount? Share forfeiture is going to be same 3 into 5,000. So in this, once the securities premium has been paid, the amount of securities premium will not affect forfeiture. Clear? Okay. Next, if securities premium has not been paid, where shares are issued at a premium, but securities premium has not been paid. Okay, same. So let us again change this example. A shareholder having 5,000 shares paid rupees 3 per share. So called up value is rupees 8. Premium is not paid. Now when premium is not paid, then securities premium will be reversed because you have not collected the money in cash. What is the use of keeping a bonus when there is no actual cash realization? So I'm not going to keep this account itself or keep this money itself. I'm going to transfer it back. So securities premium will be reversed if not paid. What will be the journal entry? Share capital account debit. What is the amount? 8 into 5,000. Securities premium account debit. How much? 4 into 5,000. 2 calls in arrears. Now, where will the securities premium appear? It will appear only in this calls in arrears because the amount has not been paid. So that will also remain in calls in arrears. So what will be the calls in arrears amount? It will be 5 rupees of called up value plus 4 rupees of securities premium. So which is total of 9 rupees. Right? 9 into 5,000. 2 share forfeiture. What is the amount of share forfeiture, friends? Share forfeiture is going to be 3, whatever is the amount received. 3 into 5,000. Clear? So, when securities premium is paid, it is not going to be touched because once received is received. It is not going to be treated as share forfeiture. Next, if securities premium is not received, we have to reverse it along with calls in arrears. So at any cost, share forfeiture amount will not include securities premium, right? So share forfeiture amount will not include securities premium. Clear with this, friends? Right? So this is regarding forfeiture of shares. Now you can now pause the video and take a minute to understand forfeiture. So this is about the accounting part. Now once these shares are forfeited, they should not be a part of share capital. So where will they appear in the balance sheet? Share forfeiture account will appear as the next line item to capital. Okay, so in the balance sheet, in the credit side or in the liability side, in the liability side, it will appear in share capital part only, but it will not appear along with share capital. You need to show a separate line as share forfeiture. right? So share forfeiture, the amount will be written separately. We'll move on to reissue of forfeited shares, which means once the shares are forfeited, they are eligible to be issued to other people or any other person as shares. Okay, this reissue has no restriction with respect to price. Okay, which means there is no stipulation that I have to issue it only at par or only at discount or only at premium. So reissue can happen at par, premium or discount. Reissue can happen at par, premium or discount. However, okay, now there is one small restriction. What is the restriction? Only when it is issued at discount. We all know that issue of shares at discount is not allowed, but reissue of shares at discount is allowed. Okay, so if it is at par, you are issuing a 10 rupee share at 10 rupees. At premium, 10 rupee share at 12 rupees, 13 rupees, 14 rupees, whatever be the price. Issue at discount, 10 rupee share is issued at 7, 8, some amount. Now comes the question, if it is issued at discount, reissued at discount, technically speaking, you are incurring a loss, right? So because the share capital amount is 10 rupees, but you are incurring a loss of 2 rupees, correct? Or say for example, you are going to uh, get only 8 rupees from that person, but the share capital will be recorded at what price? At 10 rupees. So here there is an inherent loss. The law says that this loss should be only to the extent of gain on share forfeiture. So the meaning is that at the time of forfeiting the share, what was the gain that you got per share? How much rupees that we gained per share? 3 rupees that we gained per share in the previous example. Which means when I reissue the same set of shares, I should issue it at a maximum price or at a minimum price of 7 rupees. 10 minus 3 rupees. So I cannot go to issue below 7 rupees. Why? Because if I'm going to issue it at less than 7 rupees, say for example, if I'm going to issue it at 5 rupees, what is the discount amount? 5 rupees is the discount amount. The issue price is 5 rupees, face value is 10, so difference is 5. Whereas what was the gain at the time of forfeiture? 3 rupees was the gain at the time of forfeiture. So additionally, you are incurring a loss of 2 rupees, which is not allowed. Clear? So if shares are reissued at discount, if shares are reissued at discount, the amount of discount shall not exceed the amount of share forfeiture per share. Okay, so if I'm forfeiting the shares and gaining 3 rupees, then my discount amount can be only a maximum of 3 rupees. I cannot give a larger discount. The only reason is that you should not lose more than what you have gained. That is the rule behind this particular restriction. Clear? So what will be the entry for reissue of shares? Bank account debit. So what will be the amount? The amount that you are going to debit here is actual amount subscribed, actual amount received to equity share capital, because once reissued it will also become the share capital, right? What will be the amount? It will, even if it is issued at discount, please remember friends, like how we said in premium, we should not take the premium amount in the capital. Same way, discount amount also will not affect the capital. Share capital will always be at face value only, right? So it will be at face value. So always share capital should appear only at face value. It cannot include discount or premium, right? Now, let us take the previous case. I'm going to an example. The entry is not complete, friends. Okay, let's go to an example. For the previous 5,000 shares, okay, were reissued at rupees 8 per share. Okay, so what is the discount here, friends? The discount is 2 rupees. This issued at 8 per share does not mean it is partly paid up, not uncalled amount. It is a discount value, which means I am saying the shareholder that you pay me 8 rupees, it is enough. I will treat it as if it is 10 rupees. That is what is discount, right? So now, how will I treat this? When I say bank account, it will be 5,000 into 8. Share capital will be what? 5,000 into 10. Ideally speaking, it is a discount issue. So the difference of 2 rupees is a loss to us, which has to be taken to a loss account. Here, we are going to take this to the account called as share forfeiture. Because we have already recorded some gain in that account, we will use that amount for this loss. Okay, so discount on reissue. Here, so what will be the amount? 5,000 into 2. Clear, friends? So, please remember, when shares are reissued at a discount, then the amount of discount should not exceed the face value of equity. Sorry, the amount of discount should not exceed the share forfeiture amount of the forfeited shares. Clear, friends? Okay. So, the only checkpoint here is that reissue can be made at a discount provided it does not exceed the discount value or the share forfeiture value. Now comes the next question. Here, the share forfeiture value was 3 rupees per share, but the discount amount is 2 rupees per share. So now what will happen to the difference? The difference is, okay, going to be taken as a permanent gain, right? So any balance in share forfeiture after reissue. Till reissue, I have to retain it only at share forfeiture account. Okay, so as and when shares are reissued, I can move it to the permanent gain if at all there is a gain. So what is this permanent gain? It is a capital gains. Okay, so I am going to take it to an account called as capital reserve. It is a capital transaction. Okay, a gain on a capital transaction. So I am going to take it to capital reserve. So what is the journal entry, friends? Share forfeiture account debit to capital reserve, right? So any balance in share forfeiture after reissue has to be transferred to capital reserve, right? So let's have a quick understanding again of reissue of forfeited shares. Reissue can happen at par, premium or discount. The discount amount should not exceed, that's right, the discount amount should not exceed the value of shares forfeiture at the time of forfeiting the shares, right? Next, what will happen to the balance in share forfeiture after reissuing the shares? If there is a balance, then that balance will be taken to capital reserve. Can there be a negative balance in share forfeiture? No, there is no chance of having a negative balance in share forfeiture. The reason is because there is this restriction. My discount amount cannot exceed share forfeiture, so therefore I cannot have a negative value at all. Clear, friends? So this is about reissue of forfeited shares. Okay, now pause and take down. So in this chapter, we have seen basics of a company form of organization. We have also seen about how shares are allotted in a company, and how to account for equity shares in case of issue of equity shares. For cash, then we saw about consideration other than cash. We also saw forfeiture and reissue of shares. This is all about equity shares. Accounting for preference shares is not a part of your syllabus for foundation, hence not discussed in this region. It is, like I told you, it is similar more or less to equity shares, but with certain changes which you will be learning at different stages of accounts at the next levels. Clear, friends? So the next video that we will be discussing is on another topic called accounting for debentures, right, which will be the next part of company accounts. Until I see you all in the next video, have a nice day. All the best.